Have you ever wondered why some people slowly build real wealth, while others work for decades and still struggle financially? The answer isn't always a higher salary. More often, it's a simple habit repeated every single week. Imagine investing just $30 every week. At first, it feels almost meaningless. $30 is less than what many people spend on coffee, fast food, or online shopping in just a few days. Because the amount seems small, most people never believe it can change their future. But investing isn't about making one huge decision. It's about making hundreds of small decisions that quietly grow over time. While many people focus only on earning more money, successful investors focus on making their money work for them. Every dollar invested becomes a small worker that never asks for a day off. Those dollars continue working whether you're sleeping, traveling, or spending time with your family. This is where time becomes your greatest financial advantage. The longer your investments stay in the market, the more powerful compounding becomes. Not only can your original investment grow, but the profits it earns can also begin generating new profits. That creates a snowball effect that gets larger every single year. Many beginners believe they need thousands of dollars to start investing. That's simply not true. Building wealth has never been about starting with a fortune. It's about building consistency before building size. Think about it this way: if you save $30 every week, you're creating a habit that can continue for years. During market declines, your money buys more shares at lower prices. During market rallies, those shares grow in value. Either way, you keep moving forward because your plan never changes. That's why long-term investors don't panic every time the stock market moves. They understand that temporary declines have happened throughout history, yet the market has continued moving higher over long periods. Now imagine repeating this simple habit for decades instead of just a few months. Week after week, month after month, year after year, the results begin looking completely different from what most people expect. In today's video, we're going to follow the journey of Jake, an ordinary investor who decides to invest just $30 every week into a carefully diversified Fidelity Index Fund portfolio. You'll discover how a small weekly investment can gradually grow into a portfolio capable of generating around $9,000 every month in passive income through the power of long-term investing, dividend reinvestment, and compound growth. More importantly, you'll understand why consistency matters far more than trying to predict the perfect time to invest. So before we calculate the numbers, let's first understand why weekly investing works so well in today's economy. Even when inflation, rising prices, and market uncertainty make investing feel intimidating. Now that we understand why consistency matters, let's look at the biggest challenge facing almost every investor today: the rising cost of living. Every year, life becomes a little more expensive. Groceries cost more than they did a few years ago. Gas prices fluctuate. Rent continues to rise in many cities. Insurance premiums increase. Even simple everyday expenses quietly become larger over time. Most people notice these changes, but very few realize how much they affect long-term wealth. The biggest problem isn't just inflation. It's the fact that our income usually grows much slower than our expenses. Imagine receiving a small raise at work. At first, it feels exciting, but after paying higher rent, more expensive groceries, utility bills, and insurance, that raise often disappears before you even notice it. That's why relying only on a paycheck makes financial freedom difficult. Your salary depends on your time. If you stop working, the paycheck usually stops too. Investments work differently. They continue growing whether you're working, sleeping, or enjoying time with your family. This difference changes everything. Instead of asking, "How can I work more?" successful investors ask, "How can my money work harder than I do?" That's exactly why weekly investing becomes so powerful. Nobody knows what the stock market will do next month. It may rise, it may fall, it may move sideways for weeks. But when you invest the same amount every single week, you remove the pressure of trying to predict the perfect moment. When prices fall, your $30 buys more shares. When prices rise, the shares you already own become more valuable. Both situations help long-term investors. History has shown this repeatedly. The market has survived recessions, financial crises, high inflation, global pandemics, and countless periods of uncertainty. Every major downturn felt scary while it was happening. Yet over long periods, the market continued recovering and reaching new highs. That's why experienced investors stay calm during market volatility. They understand that temporary declines are not the end of the journey. They're simply part of the journey. Now let's return to Jake. Jake isn't trying to become rich overnight. He isn't chasing risky investments or hoping to get lucky. Instead, he commits to one simple habit. Invest $30 every single week. Some weeks the market is up, some weeks it's down, but Jake never changes his plan. Month after month, year after year, his portfolio quietly grows larger. The real secret isn't finding the perfect investment. The real secret is having the discipline to continue investing when everyone else becomes emotional. And that's exactly where the magic of compound growth begins to accelerate. In the next section, we'll see how even small weekly investments slowly transform into a snowball that becomes larger and more powerful with every passing year. Now that Jake understands why consistency beats perfect timing, the next question becomes even more important. Where should that money actually go? Many beginners believe successful investing means finding the next hot stock before everyone else. They spend hours watching social media, reading headlines, and chasing companies everyone suddenly starts talking about. Sometimes it works for a while. Most of the time, it doesn't. The biggest fortunes in the stock market weren't built by constantly jumping from one investment to another. They were built by owning great businesses for decades. That's exactly why index funds have become one of the most trusted investments in the world. Instead of buying one company, an index fund lets you own hundreds, or even thousands of companies with a single investment. If one company struggles, the rest of the portfolio continues working. That's the real power of diversification. It lowers risk while giving you exposure to businesses across many industries. Now imagine Jake investing $30 every week into a carefully selected Fidelity portfolio. He isn't trying to predict tomorrow's headlines. He isn't chasing the newest trend. Instead, every week he quietly buys small ownership in America's strongest companies: technology, healthcare, finance, industrial businesses, consumer brands, and many other sectors that continue growing over time. Some companies will have difficult years. Others will break new records. But together, the portfolio keeps moving forward. That's why experienced investors focus on building the right system instead of making perfect predictions. Because nobody can accurately predict the market every year. But history has repeatedly shown that diversified portfolios reward patient investors over the long run. Another advantage is simplicity. Jake doesn't need to check stock prices every hour or panic during market corrections. His strategy never changes. Every week, another $30 is invested. Every dividend is automatically reinvested. Every year, his portfolio becomes stronger than the year before. The progress may look slow at first, but behind the scenes, compounding is quietly accelerating. Each investment earns returns. Then those returns begin earning returns of their own. Over time, that snowball grows larger and faster, creating wealth that feels almost impossible during the early years. In the next section, we'll look at the 5 Fidelity funds Jake selected and discover how each one contributes to building long-term wealth and reliable passive income. Now that Jake understands why diversification matters, it's time to look at the actual funds that make this strategy work. Instead of choosing random investments, Jake builds his portfolio around 5 carefully selected Fidelity funds. Each one has a different job, and together they create a balanced system designed for long-term growth. The first fund focuses on the entire U.S. stock market. Rather than investing in only a handful of companies, it gives Jake ownership in thousands of businesses across nearly every major industry. That means whether technology, healthcare, finance, or manufacturing leads the market, his portfolio continues participating in America's economic growth. The second fund targets mid-sized companies. These businesses are already established, but they still have plenty of room to expand. Many of today's largest corporations were once mid-cap companies. By investing in this part of the market, Jake adds another layer of long-term growth potential to his portfolio. The third fund focuses on companies that are preparing for the future. These businesses emphasize innovation, sustainability, and strong financial management. As industries continue evolving, companies with solid long-term strategies often become tomorrow's market leaders. This gives Jake exposure to sectors that may benefit from future economic trends. Next comes a fund designed to balance growth with dependable income. Instead of chasing risky opportunities, it invests in high-quality companies with stable earnings and consistent dividend payments. These businesses help provide reliable returns even during periods of market uncertainty. Finally, Jake adds a dividend growth fund. Its purpose isn't simply to pay dividends today. Instead, it focuses on companies that regularly increase their dividend payments year after year. As those dividends grow and are reinvested, they purchase even more shares, creating an even stronger compounding effect over time. When all 5 funds work together, Jake isn't depending on one company or one industry. He's building a portfolio that spreads risk, captures opportunities across multiple sectors, and steadily grows stronger with every passing year. The beauty of this strategy is its simplicity. Jake doesn't need to predict which company will become the next superstar. He simply stays consistent, keeps investing every single week, and allows time to do the heavy lifting. In the next section, we'll combine all 5 funds, calculate the portfolio's overall performance, and see how Jake's small $30 weekly investment can gradually grow into a portfolio capable of generating around $9,000 every month in passive income over the long term. Now comes the part Jake has been waiting for. Instead of talking about theory, let's run the numbers and see what this portfolio could realistically become over time. Jake commits to investing $30 every week. That's about $1,560 per year. For many people, that's less than the cost of a few restaurant meals each month. It doesn't feel life-changing today, but that's exactly why compounding surprises so many investors. After the first year, Jake has contributed around $1,560. The portfolio has only begun its journey, but every dollar is now working instead of sitting idle. The dividends earned during that first year are automatically reinvested, quietly buying even more shares. By year 5, Jake has invested $7,800 of his own money. At this stage, the portfolio has started growing from 2 different engines. One comes from his weekly contributions. The other comes from market appreciation and reinvested dividends. The snowball is finally beginning to roll. Fast forward to year 10. Jake has remained consistent through good markets and bad markets. He never tried to predict crashes or chase hot stocks. Because of that discipline, his portfolio has grown far beyond what his contributions alone could have achieved. The real transformation happens during the next 20 years. Every dividend purchases additional shares. Those shares generate even more dividends. Each year the portfolio becomes larger, and each dollar invested begins producing more income than the year before. By year 30, the results become remarkable. A simple $30 weekly habit has the potential to grow into a portfolio approaching $1 million. More importantly, that portfolio could generate roughly $9,000 every month in passive dividend income, depending on future market performance and long-term returns. Think about that for a moment. Jake didn't build this wealth by making risky trades or finding the perfect stock. He built it by following one simple routine every single week, regardless of what the headlines said. That's the real lesson behind long-term investing. Small actions repeated consistently often produce extraordinary results. Time, discipline, and compounding become far more powerful than trying to predict the next market move. And in the final section, we'll break down exactly where Jake's future wealth comes from, showing how a relatively small personal investment can eventually grow into a portfolio that does most of the work for him. We've reached the end of Jake's investing journey, but in many ways, this is where his real journey begins. After investing just $30 every week with patience and discipline, Jake has built something far more valuable than a large portfolio. He's built financial freedom. Over 30 years, Jake contributed only a small fraction of his final wealth from his own pocket. The overwhelming majority came from compound growth, reinvested dividends, and decades of staying invested. That's the lesson most people miss. We often believe wealth is created by making one brilliant investment. In reality, wealth is usually built through thousands of small decisions repeated consistently over many years. Jake never needed to predict market crashes. He never needed to find the perfect stock. He never changed his strategy every time the financial news became negative. Instead, he trusted a simple system. Every week, another $30 was invested. Every dividend was reinvested. Every year, his portfolio became a little stronger. Eventually, that simple habit grew into a portfolio capable of generating around $9,000 every month in passive income. That's the incredible power of consistency. Remember, investing isn't about getting rich next month. It's about giving your future self more choices. The earlier you begin, the more time compounding has to work in your favor, even if you start with a small amount. What matters most is building the habit and staying committed through every market cycle. One decision made today could completely change your financial future decades from now. If there's one message to take away from this video, let it be this. Don't wait until you have more money to start investing. Start with what you can. Stay consistent, be patient, and let time do what it has done for generations of successful investors. Thank you for watching. If you enjoyed this video and found it valuable, don't forget to like, subscribe, and turn on the notification bell so you never miss future investing and passive income strategies. I'll see you in the next video.